Hello everyone, welcome back to Forex Signals TV. I'm Shain Vernier, analyst over at ForexSignals.com. Today we're going to talk about the 5 fatal mistakes many traders make. If you make these 5 mistakes, it's a one-way ticket to the poorhouse. You will not be solvent or a professional trader for very long. Now, it's not enough to just point out what other folks do wrong. We also have to give you some pointers and some tips for how you can adapt and overcome these fatal mistakes. So let's get over to the trading lab. Let's dig into the charts. Let's see what we can do and help you become the trader that you want to be. Okay, let's talk a little bit about the 5 fatal mistakes traders make. If you make these mistakes, I guarantee you wind up in the poorhouse, probably sooner rather than later. The first one is overtrading. We all know what overtrading is. It's when we're placing an abundance of trades within a short period of time with no real compelling reason to do so. If you find yourself doing that, you're overtrading, and it's a major, major problem. Number 2 is don't use stop losses. A lot of people do not use stop losses in the live market. If you do that, if you practice that type of trading methodology, it's a matter of time before the market blows up in your face, either to the bull or to the bear, and wipes your account balance out in a very, very quick, short, compressed period of time. Number 3, small profits. Taking small profits repeatedly is just as dangerous as taking large stops repeatedly. You have to understand that when you dodge in and out of profitable positions prematurely, you're cutting off the trade's potential. That initial risk is still very, very much in play, and you're going to find taking small profits and taking big losses inevitable. Over time, that's just the way this works. If you take small profits over time, you're running into a big issue. And number 4 is bad timing. I'm talking a lot about timing. Timing's everything in the markets, and a lot of folks do not know when to trade. And if you're going to be in the markets, if you're going to trade anything from crude to corn to the Euro USD, you have to know when the market is active, and you have to be able to recognize when it's a good time to trade. If you can't do that, you're going to find yourself trading rotational strategies and trends in rotational markets. Each one of them takes you right back to the poorhouse. Number 5 is people lose perspective. When you lose perspective, you have no idea what's going on in the markets. You don't know which way is up or down. And believe it or not, it happens very, very quickly when you're trading on compressed time frames. It's always important to keep your perspective when you're trading the live markets. Remember, a 1-minute chart's not a monthly chart. And we're going to talk about how you can solve these 5 problems and a little bit more here in a second. In any case, the biggest thing I want you to take away from those 5 fatal trading mistakes or errors or whatever you want to call them is if you make those 5 mistakes or a combination of a few of them, you're officially gambling. You might as well be down the road in Vegas playing roulette. You have no positive expectancy. You have no edge in the marketplace. Those are 5 edge killers, and when you get your edge mitigated, there's no reason to even trade. You have to make sure that you avoid those 5 fatal errors, or else you might as well just go bet it all on black, cross your fingers, and hope it comes up aces. And lastly, it's not enough to just point these things out. It does me absolutely no good to sit here and say, well, here's 5 things traders do, and this is the way that they blow their account out and really struggle to establish any sort of consistency in the markets. We have to talk about how to solve the problem. If you cannot solve the problem, then there's no point of moving forward. So I'm going to show you a few ways how to solve each problem, but to do so, we got to get back over to the trading lab. All right, buckle up. Let's get the charts out. Let's see what we can do. Okay, let's talk about the first mistake, fatal mistake that traders make, and that's overtrading. You must avoid overtrading at all costs. There's a few ways that you can do it. Number 1, focus only on those premium trade setups. Those are the setups that give you the greatest expectancy, your highest edge in the markets. You know when you see a premium setup, you have a very good chance of winning. Focusing on those and ignoring the rest really eliminates the noise and the temptation to overtrade. Number 2, adjust your periodicity. I see it day after day after day. Traders want to get into the market and they want to trade 1-minute charts, 250 tick charts, 300 tick charts. They want to be hyperactive, and it's natural. If you get that temptation, don't feel bad. Remember, you want to be a trader. You're a trader. Well, traders typically trade to make money. We feel like we have to be in the market all the time to do so. That's categorically false. It's simply not true. Think about this. Adjust the periodicity on your chart. Your strategy gives you a pattern-based, maybe a momentum algorithm-based methodology. Adjust the periodicity. Instead of a 1-minute, use a 5-minute. Instead of a 5-minute, use a 30-minute. That can easily reduce the temptation that you may have to get in the market repeatedly over the course of a trading session. Remember, there's 1,440 1-minute candlesticks in a trading day. That's a lot of candlesticks. You could easily be making 300 or 400 or 500 trades if you're not disciplined. Adjust the periodicity, focus on your premium trade setups. That will take care of overtrading for you. Second, you must use stop losses in the live markets. A lot of traders don't. They figure that, well, the market will eventually come back my way and I'll have an ability to get out at a better price or at least take some sort of a profit. Simply not true. Eventually, you will get caught against a trend and you will be wiped out. That's a fact of life. Two types of stop losses. Number one's a mental stop loss. A mental stop loss is either a position on your pricing chart where you know you need to get out, that your idea is incorrect, or it could be a percentage of your risk capital, maybe 1 to 3%. Once you hit that threshold on a given trade, you're out. No fuss, no muss, exit the market, and that's pretty much a wrap for the trade. Both of those are just fine. Physical stop losses are a bit technical based. You're going to put those on the pricing chart at a key point where you know your trade's incorrect. So let's take this example. Let's say, hey, I really love the pound right here. I love the pound dollar. I'm going to buy in from 118. We've got a nice little zone setting up, some compression. I'm looking for a bullish break, maybe fill in some of this bearish price action. I'm long from 118 and I'm confident about it. If I don't have a stop loss, I've just been caught up in a 4-day trend, and bet the most important part of all of it is I don't know where the trend ends. And if I don't know that, I know I'm in big, big trouble moving forward. Where do I get out? I get out when I run out of money. That is the path to ruin. So remember that stop loss is either a mental stop loss or a physical stop loss. Absolutely imperative. Let's talk about number 3. Taking small profits can be the road to ruin. It's almost as bad as not having stop losses. Well, not having a stop loss can wipe you out quick. This can eat you down over time. This can really undermine the efficacy of any trading methodology. In any case, when we take small profits, essentially we're cutting off the potential, the upside potential of our trades. We're really getting into the habit of sort of having very, very small expectations and figuring, well, if we can dodge in and out of enough winning positions, we can make money. Here's 3 ways that you can get out of that. Number 1, you can adhere to profit targets. You can put down a profit target for each and every trade. If the profit target is not hit, then it's a loser, and that's just the way that it is. Number 2, you can also have implement risk versus reward ratios. One of the keys to risk versus reward is balancing that initial risk versus a trade's potential. You can do that on each and every trade. It's a situation where you may not be hitting your profit targets consistently, but if they're larger than your stop losses, you may have an opportunity to make money over time. And number 3 is just flat take a hands-off approach to trade management. Say, listen, I've got a profit target down, I've got a stop loss down, I have a risk versus reward relationship. I'm going to just let it play out the way that it may. A lot of traders do that. Automated systems are one way. Just being disciplined and getting away from the screen and saying, okay, my trade's down, it's live, I am officially out of the mix. Those 3 things can help you get away from taking small profits repeatedly and really undermine your strategic potential. Okay, let's talk about lethal mistake number 4. That's bad timing. It says right there, bad timing can be lethal. Underline it, bold it, exclamation points, whatever you need. Remember, timing is everything in the market, and that can kill you in a couple of different ways. Number 1, you can be trying to trade a trend strategy during flat markets. Guaranteed you're going to lose money. If you don't lose a lot of it quickly, you're going to lose it over the long haul. Number 2, trading reversion, rotation markets in trending markets. That can crush you just as fast. You'll notice that you're taking positions and you're constantly getting stopped out as you're just seeing no retracement of price back towards your median profit target. And how can we avoid this? Number 1, we've got to realize market state. We made a video not too long ago about market state. Feel free to review the 3 ways you can understand when to put your different strategies on. But here's 2 pointers that can clear up this situation for you very, very quickly. Number 1, know your market hours. Right here, this is a chart of a US 30. This is a 30-minute US 30 chart. You have to understand that in order to trade the Dow 30 US stocks, the most active time of the day is going to be during the New York session. Now, when is that? Well, shortly after the opening bell, 9:30 a.m. Eastern, and shortly before the closing bell at 4 p.m. Eastern. You have to understand those are active times in the market. You can easily see when markets move. Volatility presents itself. We have opportunities to make trades. Our strategies have validity. We have an edge. And number 2, don't trade the market when it's dead. Very simply put, it's right in front of you. This is a nice trending market, develops during those NYMEX hours. There's participation, there's volatility. It's an active environment. We have an opportunity to capitalize on inefficiencies in price. And then you'll notice right after the close, as we sort of wind into the Asia Pacific session, things get slow. Price action gets very choppy. Our 30-minute ranges get tiny, and that's indicative of just a lack of participation and or opportunity. Bad timing can be lethal. Understand when to trade and understand when to sit on your hands. All right, and then the last mistake, it's one that we all fall victim to at one time or another, so don't feel bad if you're losing your perspective. You have to understand what the big picture is. You have to keep your perspective. If you're trading short, compressed time frames, you have to understand, well, maybe this isn't the end-all be-all. Maybe this 30-minute chart isn't telling me everything I need to know about the markets. There's two ways to really solve this problem quickly. Number one is to use multi-time frame analysis, and that could be as easy as going from a 4-hour to a 30-minute to a 5-minute, or you could go from a monthly to a weekly to a daily. And number two is to take in the view from 10,000 feet. Step back. Take a minute and say, okay, I've been looking at 30-minute charts and 5-minute charts for so long, I forgot what the broader picture is. Take a look at this chart right in front of you. WTI crude oil on a 30-minute chart. It looks like this is the downtrend of the century. Epic move, consolidation, epic move, retracement, failure, moving south. Clearly the trend of the century. Let's cursor over to a weekly WTI chart. Same product, different time frame. What's the view from 10,000 feet? This market is in deep consolidation. Sure, there's been some bearish action this week, and maybe we could have capitalized on it here and there. Bigger picture, if I'm selling right now, I'm selling right into the middle of a larger value area. My probability of having a winning trade has decreased. And guess what? I'm right back at the roulette table. I've got all my money on black, and I'm hoping that my bet comes in. That's not what we're about. That's not winning trading. All right, let's talk a little bit more about what it can take to get you on the right track and what you may need, some extra resources, what you need to succeed in the future. Those are the 5 fatal mistakes that traders make on a daily basis. The number one thing to remember if you're making one or more of those mistakes is you don't have to keep making them. We have all been there. We have all been there. Through a little bit of time and effort, you can become the trader that you want to be. Now leave us a message below, harsh critique, pat on the back. It's all the same to me, I don't mind. Also check us out on the socials. That's a great place to keep an eye on what we're doing and what's happening in the Forex Signals world. Until next time, trade the action well, and we'll talk soon. See you.